Hey folks, when I take a look deep down into the core of my investing soul, it will always reside with dividend stocks, because as much as I love the Teslas, the Bitcoins, the Facebooks of the world, I always recognize that sooner or later, at some point down the road, I am going to have to sell that to take a profit and then figure out what I'm going to do with that capital to continue to grow up. But when it comes to the dividend stocks that will continue to pay my bills in perpetuity, whether I'm asleep, on vacation, on the beach, or heck, because we're going to Vegas to meet up with you guys coming January, which I'm hoping some of you are going to show up, I'm still going to be collecting cash flow. And I have two dividend stocks today that I believe will also offer capital growth and dividend compounded growth that is going to take you into retirement and probably feed you for the next 50 years here, folks. One of these is on the Canadian side of the borders. One of these is on the US side of the border. To give the most diversity, as I personally bought both of these yesterday, and I'm going to continue to buy them into the future. And we're going to kick this off. But before we do, in the clarity of my transparency, if you guys enjoy the documentation of my financial independence to one day retire early, consider hitting that like button, folks. And let's zoom out by kicking it off on the Canadian side of the border with TELUS Communication here, folks. The very first telecom company I ever bought. And don't make the mistake of putting T stock into Google, because AT&T also trades under T stock, but on two different exchanges. This one is T.TO, or it trades on the TSE under the ticker symbol T. And this company right now pays a 4.8% dividend yield, but that is not the most impressive thing. It is how rapidly they've been able to grow that yield, because just take a look at this beautiful chart, guys. Going back to 2015, if you bought TELUS back in 2015, your starting dividend would have been around 20 cents a quarter. And if we skip to today, your dividend is now 31 cents, an increase of over 50%, guys, meaning if you capped in a 4% dividend yield 5 years ago, you managed to hold on to it today, you'd be looking at a 6 to 7% dividend yield. And can you imagine what a decade or 20 years of holding on to a company like this could do for your cash flow, folks? And on top of that, over the last 5 years, if you managed to buy T on the dips, you'd be trading up about 25 to 28%, giving you at a market average return of roughly 11 to 12% a year. And this is something that I think is not only going to continue, but it is also going to accelerate moving forward, because these communication companies in Canada have relatively small caps. A $33 billion market cap is nothing that astounding, but how do you get growth in these kind of companies? These are like infrastructure companies. They're like utilities. It's almost like real estate. And where's the best place for these kind of companies to be? Well, places where economies are growing. And right now, I've said this many times in the past, Canada is one of the fastest first world growing nations, guys. It is outgrowing India and the US in population, and that is a very good, healthy thing for real estate, utilities, and telecom, guys. And we're going to see this if we actually get into their books, which I'm going to show you in a second. But you guys should know that if you use any telecom provider, I personally am using a different company. We only have, I think, 3 or 4 major telecom companies in Canada. And taking a look at TELUS's plans that are comparable and competitive, in my opinion, for $80 a month, you can get 30 gigs of data, unlimited nationwide calling, and unlimited nationwide text. I've had a lot of arguments recently about what could disrupt the telecom industry, and a lot of people were saying Starlink might be able to compete, because I am personally using phone data to do a lot of my live streams and even upload a lot of these videos. But the difference with Starlink, you need a huge, massive satellite. It costs a hell of a lot more than $80 a month to maintain, and you're primarily buying that for a home-sourced internet base, because you're going to get a lot more data access. But it's also for more rural areas, where most people that are buying phone plans, guys, even though I live in a rural area, a lot of people will be utilizing that infrastructure in cities, and that is not the primary focus of something like a Starlink. So I do believe in the long term, I do believe in the longevity of the infrastructure of these telecom companies, guys. And just take a look at the growth rate here. For the 3-month end, for the last few months of 2020 here, guys, they grew their revenues by 5.2%, and they increased their total subscriber connection by 5.3%. The thing that I don't like most about this company is if we take a look at their total assets, they're sitting on about 43 billion. And if we minus it from their total liabilities, guys, of 30 billion, they're sitting on about what, 13 billion in total underlying assets, which is trading a hefty way away from that market capitalization. So you're paying a hefty premium against those underlying assets. But again, taking a look at the growth rate, it is steady, healthy, and stable. And one of the reasons that I think the stock has been selling off a little bit is obviously related to this pandemic. They have been doing more write-offs, more things to obviously protect their clients and their customers here. So they have seen a drop off in earnings. In fact, they missed every earnings expectation dividends through 2020. But even still over the last year, the stock is trading up, and only as of recent has been taking a little bit of a ding. It's only trading down about 4 or 5% from the all-time highs. And I kind of like the stability of this company for that reason here, folks. Diving down into the forward-looking information here, we're going to take a look at the price to earnings, which if you don't know what the PE ratio is, just to simplify it, guys, it's how much I'm paying for the company today versus how much earnings it achieves year over year. So if the PE is 27 and that company doesn't grow or lose earnings, it would take 27 years of that company's earnings capabilities to pay me back off what I'm paying for it today. So that is a hefty premium, but because the company is growing bottom line earnings and revenue, we can see that the forward PE is actually closer to a 19, which is really good because if it continues to keep up that growth rate, guys, in the next 3 to 5 years, you'll actually be getting a super big discount versus what you're paying today. And what turns people off a lot is taking a look at the security and the reliability of that dividend, because currently the payout ratio, which basically reflects how much money they're paying out versus what they're keeping, is 126%, which is a little convoluted because that means they're paying out over 100% of the money they're making. But that's not exactly accurate. Because of the pandemic, these companies do not only bigger write-offs, but they're also paying into do protection, upkeep, all the stuff that comes into play. But usually it's highly related around amortization costs, which means they write down their assets, like your car. Let's use that as an example. Now, that car, even though it's costing you gas and insurance and stuff, the price of the vehicle isn't really costing you anything moving forward, but the price of the vehicle is degrading over time. Now, people in my position, let's say, that run their own business will write the degrading value of that car off over time. Even though I'm not putting more money into paying for that car, I can still write the value it's losing off over time, if that makes any sense here, guys. So that is technically what they do. And the only reason that we know that their dividend is affordable is by going back into that balance sheet here, folks, and just taking a look at the cash flow. I always recommend don't look at payout ratio, go look at free cash flow, because that's where the real numbers reside. And we can see their free cash flow has been relatively sustainable for 2020 at about 1.75 billion. I can promise you they can definitely afford that dividend yield. Currently, guys, I just picked up 105 shares of this company at $25.90. I do plan on picking up a lot more. This is a fairly tiny starter position, and I had to move companies around to start buying this. I recommend subscribing. I do full updates at the end of every week on where my portfolio sits and what I've adjusted. So very happy overall, getting $120 a year right now, roughly, off this initial purchase, and I'm hoping it starts to trend downways. I'd really like to pick this up if it can take any major dip. But yeah, TELUS Communication, guys, the first dividend stock on the Canadian side of the border for new dividend stocks that I'm buying. So let's move into the US side of the border now on one that I had to sell, and I recently just started buying it back. And that, of course, is Lockheed Martin, which is having a bit of a comeback over the last week here for sure. Lockheed Martin has been flying under most people's radars here, and it currently pays at a 2.94% dividend yield. It is a massive conglomerate with a $100 billion market cap and a PE of 14, and it is definitely trading at a much larger discount than TELUS Communication. But just as impressively, guys, their dividend increases are absurd. Going from 2015, when they were paying out $1.50 at a starting 3% yield, to today, they're paying out $2.60, over a dollar increase, being about a 66% increase overall, taking your starting 3% dividend yield to over a 5% dividend yield just 5 years later. Some pretty staggering stuff. And if we include the 5-year in the capital growth rate, guys, you are doing incredibly well. It is trading up 62%. So again, you're getting about market average return or just above if you continue to hold over the long term with those dividend increases here, folks. Now, Lockheed Martin is one of my favorite stocks because it is an aerospace company. A lot of people do not like this company because it is largely exposed to the Army. They build everything from rockets to jets to helicopters to being responsible for putting Perseverance on Mars. And this is where my giddiness comes out, because as a kid, I absolutely love space. I'm obsessed with SpaceX, rockets, all this stuff. And the fact that I can own something that is responsible for the upcoming lunar missions, the Mars missions, putting Perseverance on Mars, yeah, hell yeah. I absolutely love that, guys. And more impressively than not, a lot of people were fearful that the Biden administration was going to cut a lot of the expenses and money that they're putting into the U.S. Army. And I'm really glad that they haven't done that. They've continued to build up expenditures, because I believe a lot of the innovation in the future is going to come from a company like Lockheed, and a lot of jobs, a lot of employment in the mix of this pandemic is coming from the Army and aerospace. So there is no reason that I could foresee them ever cutting the contracts. And because I think about 70% of their income right now comes from from the government, and 30% is coming from foreign exposure and a lot of other stuff, which we're going to take a look at in a second. A lot of people hate the overall morale of being exposed to a company that is building rockets and is responsible for, weaponry that ends up killing people, but it's kind of the risk that comes with the protection too of the US economy, guys. But I'm telling you, scroll through their press releases because they have endless brand new contracts coming out that just, my jaw hits the floor at how many new contracts they are achieving here, folks. And just take a look at the diversification. So their top segments right now are aeronautics, missile and fire control, rotary and mission control, and then space. Every one of these segments has been growing quarter over quarter, which again, just mind-blowing in the midst of a pandemic here, folks. But let's take a look at the year over year. So aeronautics has grown from 23 billion to 26 billion. Missiles has grown from 10 billion to 11 billion. Rotary and mission systems from 15 billion to 15.9 billion. And then you got space, my favorite of the bunch, going from 10.8 billion to 11.8 billion over the course of the pandemic in 2020. Just like TELUS Communication, guys, the thing that I hate the most about this company is the fact that their total assets sit at about 50 billion and their total liability is around 44 billion, which means they've only got about $6 billion in underlying assets, which has been getting it's increased slightly over time. It's a company that keeps hardly any assets under the table, primarily due to the fact that they are a relative essential service to the US economy and the US government. So I'm presuming that's why they're a little bit more highly leveraged, because there's probably a little more sustainability in that cash flow, folks. And just taking a look at the forward-looking statistics as well. Actually, let's just take a look at the revenue first, just to show you guys that it is increasing substantially. I shouldn't overlook the revenue because they've met every earnings expectations quarter over quarter. And just taking a look, if we go back to the income statements, guys, from 2019, they did 59 billion in earnings. Going to 2020, in the midst of the pandemic, 65 billion dollars in revenue, guys, is just stupid. So their increase is incredible. So going into those forward-looking statistics again on those PE ratios, it is going to go from a 14.5 is expected to drop to about a 12.6. So you're not looking at the fastest forward PE drop down, but again, guys, when you look at the current payout ratio that only sits at 40%, we have plenty of room to continue to grow that dividend, which is pretty incredible overall. So putting that aside, guys, I just bought a bunch more of this. I bought 18 shares yesterday of Lockheed at right around $346. It currently sits at 356. So I'm starting to see an increase on both of these companies since I purchased them. I'm super pumped up for both of these for two different particular reasons. I'm buying TELUS Communications in a regular brokerage account because I've maxed my tax advantaged account. So for as long as it sits there, I'm owning a Canadian company, which the government, as an investor, as a Canadian investing in the Canadian economy, gives me tax benefits on those dividends. I actually end up paying way less tax than if I were to own a US company in my regular brokerage account. So what I went ahead and I bought Lockheed Martin in my registered retirement savings plan account, being my RRSP. What that does for me, guys, is essentially being a Canadian investor in the US economy, I have to pay over the border withholding tax, but luckily the Canadian government says, hey, if you buy US companies in your registered retirement savings plan account, we're not going to charge you that withholding tax. So it's locking in I think I'm locking in an even 3% yield with Lockheed Martin, which means I'm not going to lose any of that money moving forward. That's where I like holding some of my lower end US paying dividend stocks when we're talking about Pepsi, Johnson & Johnson, Kimberly-Clark, and finally I think Lockheed is a beautiful addition to that account. But in light of all this, I pass the question off to you. What do you guys think about these companies, and what are your favorite dividend stocks you're buying right now? And in light of all this, stay cool, stay awesome, and I look forward to catching you tomorrow.